Happy day! Today's topic is amalgamation, absorption and external reconstruction. So now, let us see what is the meaning of amalgamation of companies. So in the given example, we have two companies, A Limited and B Limited. Both of them are existing companies. Now, they are going to wind up their businesses, or in other words, their businesses are going to be liquidated to combine together to form a new company called as C Limited. So, amalgamation is the process of combining two or more businesses to form one large entity. Absorption. What is the meaning of absorption? A limited company is an existing company. Now, it is going to be wounded up. There is another company called as B Limited, which is going to purchase the assets as well as the liabilities of A Limited. So over here, no new company is going to be formed. Only B Limited is taking over the assets and liabilities of A Limited. So now what is absorption? Absorption of companies is when one company absorbs another company to form a single existing company. Reconstruction. Whenever the affairs of the companies are going to be reorganized, it is called as reconstruction. It may be of two types. One is when it is going to be internally reconstructed. Two, when it is going to be externally reconstructed. Let us see what the two types of reconstruction mean. Internal reconstruction. Whenever an internal reconstruction happens, no new company is formed. For external reconstruction, there is a new company which is going to be formed. In internal reconstruction, what is going to happen is that all fictitious assets are going to be written off, the capital of the company is going to be reduced. Whereas in external reconstruction, it is just going to operate like an old wine in a new bottle. There will be an old company and the statement of affairs of that particular company is just going to be modulated into the new company. What is the difference between amalgamation, absorption and reconstruction? So now let us see the various bases of distinction. Formation of a new company. In amalgamation, a new company is formed. In the previous example given, C Limited was a new company which was being formulated. Number of liquidating companies. At least two companies are required to wind up their business. Objective. What is the objective of amalgamation of companies? To remove competition among the entities. Absorption. In the case of absorption, no new company is going to be formed. We saw the example of A Limited and B Limited, where B Limited took over all the assets and liabilities of A Limited. So number of liquidating companies, at least one company is required to wind up the business. Generally, weaker units are going to be taken over by the stronger units, and that is the reason for any absorption to happen. Then, in the case of reconstruction, no new company is formed if it is going to be an internal reconstruction. A new company is formed if it is going to be external reconstruction. Now, one company is required to wind up its business. The aim of the external reconstruction is to write off the accumulated losses and fictitious assets. As per Accounting Standards 14, the treatment for absorption and amalgamation is the same. Now let us look at the terminologies used for the company which is going to wind up its affairs and the company which is going to purchase the business. If it is going to be a winding up company, or in other words the selling companies, it is going to be called as your transferor companies. If the company is going to be the new company which is going to be purchasing the assets and taking over the liabilities of the company, they are going to be called as your transferee companies. From accounting point of view, there are going to be two types of amalgamation. Number one, amalgamation in the nature of merger. Number two, amalgamation in the nature of purchase. So, how do we identify whether the amalgamation is going to be in the nature of merger or whether it is in the nature of purchase? There are 5 conditions which the companies have to satisfy if the amalgamation has to be in the nature of merger. So what are the conditions? Number 1, all the assets and liabilities of the transferor company have to be transferred to the transferee company. No asset or liability should be left out while the transfer is going to happen. Not less than 90% of shareholders become shareholders of transferee company. That is, in the transferee company, the shareholders of the transferor company should be minimum 90%. Condition number 3. Consideration. It must be in the form of equity shares. 4. Intention to carry on same business. Whenever the transferee company is going to take over the business from the transferor companies, it should not just take over the assets and liabilities, it should have an intention to continue the business in future. Transfer at book value. Such a transfer should also happen at the book value. That is, the assets and liabilities taken over by the transferee company should be done at the book value. Now, only if each of these 5 conditions are going to be satisfied, it will come under your nature of merger. Even if one of the conditions is not satisfied, it will belong to the nature of purchase. Purchase consideration. Purchase consideration is the price that is paid by the transferee company to the transferor company for acquisition. How do we compute the purchase consideration? So we have 4 different methods to calculate purchase consideration. The first method is lump sum method. The second method is net assets or net worth method. Third is net payment method. Fourth is share exchange or intrinsic value of shares method. So under the lump sum method, lump sum amount is quoted by the purchasing company and it is also a rarely followed method. Under the net assets or net worth method, all the assets and liabilities are taken over. Under net payment method, different forms of payment like equity shares, cash, all of them are added up to compute our purchase consideration. Finally, share exchange or intrinsic value of shares. In that method, the shares are going to be exchanged based on a value. So let's look into few questions under each of the following methods. Number 1, under lump sum method, let us try to find out the purchase consideration. Company ABC Limited purchases the business of the company XYZ Limited at an agreed price of rupees 10 lakhs in all. What is the purchase consideration? So it is very simple. The purchase consideration is the amount which is going to be agreed to be paid. In this case, it is rupees 10 lakhs. So in this case, we are going to look into net assets method and how to compute our purchase consideration using net assets method. So there is a balance sheet given as on 31/12/2003. There are going to be 2 companies, A Company Limited and B Company Limited. The assets and liabilities are given to us. So let us move on to the question. So A Company and B Company decide to amalgamate and form new company called as C Company. The new company takes over the assets and liabilities of the companies. Calculate the purchase consideration. Computation of purchase consideration using net assets method. So assets and liabilities of the company is going to be taken over by C Limited. So here for A Limited, the assets that are going to be taken over, that is goodwill, premises, machinery, stock, sundry debtors and cash, all of them are totaled up to get our total assets that is going to be taken over, which is rupees 83,300. Now, subtracting sundry creditors, which is going to be external liabilities, rupees 3,300, we arrive at the final purchase consideration to be paid by C Limited to A Limited, which is rupees 80,000. On the other hand, for B Limited, the assets that are going to be taken over will be goodwill, machinery, stock, sundry debtors and cash. This totals up to rupees 52,000. And again, subtracting external liabilities, which is sundry creditors, rupees 2,000, we will finally get the purchase consideration to be paid by C Limited to B Limited, which is rupees 50,000. On the whole, the total purchase consideration to be paid by C Limited to A Limited and B Limited is 1,30,000. Let us move on to the next method, net payment method. White Limited agreed to absorb Green Limited as on 31/12/2006. The consideration payable White Limited was A. A cash payment of rupees 2.5 for every share in Green Limited. B. The issue of 90,000 rupees 10 shares at an agreed value of rupees 12.5 per share. The total number of equity shares in Green Limited is 60,000 of rupees 10 each. Calculate the purchase consideration. Computation of purchase consideration using net payment method. So what is the amount to be paid to equity shareholders? The payment is going to be done using two methods, number one through cash and number two by issue of shares. So for cash payment, 60,000 shares of rupees 2.5 each, which is going to total up to rupees 1,50,000. For the payment through shares, 90,000 shares of rupees 12.5 each, which is 11,25,000. Finally, this gives us our PC, which is going to be 12,75,000 rupees. Moving on to the next method, computation of purchase consideration using intrinsic value method. S Limited was taken over by R Limited. Ascertain the intrinsic value, share exchange ratio, and number of shares to be issued from the given details. So we have the particulars of S Limited and R Limited given. Number of shares in each of these companies are given. The face value of the shares are given. And the net assets value in the company is also given to us. Let us look at the first part, that is, what is the intrinsic value of the companies? So there is a formula for us. So intrinsic value is nothing but the assets available to equity shareholders divided by the number of equity shares. So the net assets in S Limited is 3 crore 60 lakhs. For R Limited, it is 72 lakhs. The number of shares in S Limited and R Limited are 60,000 shares and 90,000 shares respectively. Applying the formula, we are going to get 3 crore 60 lakhs divided by 60,000 shares, which is equal to rupees 600. For R, it is going to be 72 lakhs divided by 90,000 shares, which is rupees 80. Thus, we have arrived at the intrinsic value for S Limited and R Limited, which is rupees 600 and rupees 80 respectively. What is the share exchange ratio between the companies? So how do we arrive at that? There is a formula. Transferor company intrinsic value divided by transferee company intrinsic value. We have already found out the intrinsic value of both the companies. So just substituting the amounts rupees 600 divided by rupees 80, we get a value 7.5 by 1. So the ratio of exchange is S Limited to R Limited 1:7.5. And in S Limited, we already know that there are going to be 60,000 shares. So what is the number of shares that R Limited has to issue to S Limited? How do we arrive at that? So 60,000 shares into 7.5, just cross multiply, which is going to be 4,50,000 shares have to be issued by R Limited to S Limited. Thank you.